Moving now to investing activities using the direct method. CFI, or cash flow from investing, is calculated by examining the changes in the gross asset account that results from investing activities. Typically, we are considering purchases or sale of equipment, i.e. long-term assets. The first thing we will look at is how to determine cash paid for new equipment. To do so, we must analyze whether old assets are sold or not. And here is the simple expression that you need to know. The cash paid for new equipment is equal to ending gross equipment balance plus gross cost of equipment sold minus beginning gross equipment balance. You need to make sure you understand what gross means. If you buy equipment for 100, and let's say this equipment will be used for 10 years and every year the depreciation is 10, then after 1 year the net book value of the equipment will be 100 minus 10, assuming 10 is the depreciation every year. So you will have a book value of 90. After 2 years you depreciate 10 again and you will have a net book value of 80. So the 80 is referred to as net book value. The gross equipment value is 80. The gross equipment value is still 100. So notice the gross value is the net value plus the accumulated depreciation. Accumulated depreciation in this example is 20. So cash paid for new equipment is ending gross equipment balance plus the gross cost of equipment sold minus beginning gross equipment balance. Let's say that we start with a simple example where nothing was sold during the year. If the ending gross equipment balance is 500 and the beginning gross equipment balance is equal to 400, then this obviously means that the cash paid for new equipment must be 100, assuming of course that nothing was sold during the year. You take the end number, subtract the beginning number, and the difference has to be explained by how much cash was paid for the new equipment. Now let's say from the footnotes you recognize that the gross cost of equipment sold was 50. Then what is the cash paid for new equipment? The answer then is as follows. You have an ending balance, let's say again, of 500. So you will do 500 plus 50. The way you can think of this is, if the equipment had not been sold, then the ending balance would have been 550. And then you subtract the beginning balance of 400. You have 550 minus 400, which is equal to 150. Next, we try to determine cash inflow from the sale of equipment. This is a little more complicated. And here we need to understand the equipment amount, the accumulated depreciation, and the gain or loss on sale of equipment. The cash from sale is equal to the historical cost of the equipment sold. This is the same as the gross cost of the equipment sold minus depreciation on equipment sold. When you combine these two items, you have the net book value of the equipment which is sold. Let's say that the net book value is equal to 80. And let's say that the gain on sale of equipment, which you can easily get from the income statement, is equal to 5. The cash from sale of the equipment would then clearly be 80 plus 5, which is 85. But these numbers, however, are not so easy to come up with. They are not given to you. They have to be computed using the financial statements. So let's see how we compute these numbers. The historical cost of equipment sold is equal to the beginning balance of equipment. So this would be the gross amount for equipment. If you are looking at a given time period, let's say 2010, you will look at the beginning balance of equipment. Then you will add the equipment purchased. This information would be obtained from footnotes. So you add that, and then you subtract the ending balance. You subtract the ending balance of equipment, and we look at an example on the next slide. Depreciation on equipment sold, that is given by this formula. The beginning balance of accumulated depreciation, again that would be start of the period, plus depreciation expense minus ending balance of accumulated depreciation. These two items would come from the balance sheet. This would come from the income statement. And then you add the gain on sale of equipment. This is easy. This comes straight from the income statement. Now I want you to memorize what you are looking at over here, or at least make a note and then attempt the question on the next slide, which is given right here. So here is what you should be doing. This is simply reproducing the information from the question. The correct answer is 3.5. You first compute the historical cost of equipment sold as 3. And to come up with 3, you need to look at the beginning balance of equipment. That's the gross amount, 80, plus equipment purchased, that's 14, minus ending balance, which is 91. And then you subtract the depreciation on equipment sold, that's 1. And you get that using this expression, beginning balance accumulated depreciation, which is 25. Plus depreciation expense 7 minus accumulated depreciation at the end 31, so that should give you 1. And then gain on sale of equipment from the income statement is 1.5. Put these numbers together and you should get 3.5. Coming now to financing activities, and as I mentioned before, both with investing activities and financing activities, we only have the direct method. There is no indirect method. Financing activities deals with cash flow between the firm and suppliers of capital. The major suppliers of capital are either lenders or bondholders and shareholders, be they common shareholders or preferred shareholders. So all this cash flow needs to be shown on the financing segment of the cash flow statement. It's referred to as the CFF, cash flow from financing. If you look at the lender side, the net cash flow from creditors is equal to the net borrowing. So in a given period, this would be the net borrowing. This is how much money the firm is getting from the lenders, minus the principal amounts repaid. And these are the principal amounts repaid. In this particular scenario, we are assuming that any interest paid is shown on the CFO part of the cash flow statement. So this clearly is a US GAAP perspective, or it could also be IFRS, where we are assuming that interest is shown in the CFO segment. In terms of interaction with shareholders, the net cash flow from shareholders is equal to new equity issued. When a firm issues new equity, it is going to get cash from shareholders. So that's this over here. Minus shares repurchased. When the firm repurchases shares, it is giving money to shareholders. And then also minus any cash dividends. When cash dividends are paid, there again the firm is giving cash to shareholders. The combination of these two essentially form the CFF part of the cash flow statement. Putting all this together, you notice that we have operating activities shown right up front, and we have discussed each of these elements: cash flow from customers, and then various cash expenses such as cash paid for rent, employees, etc. Then we have investing activities, where primarily we are dealing with the purchase and sale of equipment. Even investment securities would fall in this category. So this is CFI. And then financing activities, issues of stock, increases in notes payable, that means borrowing went up, repurchase of treasury stock, this is money going out to the shareholders, cash flow from financing activities, net amount is given right here. You add all these together and that's the total cash flow. This then is a simple example of a overall cash flow statement using the direct method. With the indirect method, the only thing that would be different would be the operating segment, where we would start with the net income and reconcile down to CFO. The CFO number would be the same. Let's briefly talk about the indirect method now. Here we begin with the net income, and this comes obviously straight from the income statement. Then we add back all non-cash charges to income and subtract all non-cash components of revenue. The classic example here would be depreciation for non-cash charges. Say for a given company, the net income is 100. Since we are dealing with cash flow, we need to add back depreciation. Say the depreciation charge is 10. Remember, the depreciation was subtracted in order to come up with net income. So if we are going to arrive at a CFO number, we need to add back depreciation. We subtract gains or losses that resulted from financing or investing activities. So actually subtract gains or add the losses that resulted from financing or investing activities. The classic example would be, let's say that on the income statement we showed a gain of 5 from the sale of equipment. Now the gain of 5 caused the net income to be higher, but that wasn't a real cash flow. That gain of 5 was not operating cash flow. So what we are then doing is subtracting that gain. If this had been a loss, then we would be adding. Then you add or subtract changes to balance sheet operating accounts. And we have discussed this before. Any increases in operating asset accounts, such as accounts receivable going up, is a use of cash. So that would be a minus. So if accounts receivable is going up by 3, then we would subtract 3. If inventory has gone up by 7, then we would subtract 7. Then we deal with increases in operating liability accounts. So if accounts payable is going up by 6, we would add 6 over here. Once you put all this together, you then have a reconciliation between net income and the cash flow from operations. In order to internalize what we are talking about over here, I'd strongly encourage you to do example 7 from the curriculum. Coming now to the conversion of cash flows from indirect to direct method. This is a little bit complicated, but it is part of the learning objectives. However, I think the probability of your being tested on this material in detail is low. Nevertheless, since it is part of the learning objectives, we will go over the process. Step 1 is to aggregate all revenues and expenses. So you come up with total revenues, subtract the total expenses, and you have your net income. This essentially is your income statement. Then you remove all non-cash items from aggregate revenues and expenses and break out remaining items into relevant cash flows. The major item here would be to take your revenue and remove non-cash revenue such as gain on sale of equipment. This material, by the way, is illustrated quite well in Exhibit 11 in the curriculum. So if you also follow along from the curriculum, this discussion will be a little bit easier. The cost of goods sold, salary and wages, etc., all this information you can get from the income statement. And then you convert accrual amounts. These are the amounts from the income statement which are based on accrual accounting. So you convert these accrual amounts to cash flow amounts by adjusting for working capital changes. The working capital is your accounts receivable, accounts payable, inventory, etc. Your current assets other than cash, and your current liabilities such as accounts payable. So when we talk about cash from customers, you start with the revenue number and make an adjustment based on accounts receivable. To get cash to suppliers, you start with COGS and make an adjustment based on changes in accounts payable and inventory, and so on. This is exactly what we have talked about earlier. So you make the adjustments and come up with the various cash payments, and then you have your final number for CFO. Notice we are only dealing with operating cash flows because for investing and financing, the material is always presented in the direct format anyway. Cash flow statement analysis. The analysis of a company's cash flows can provide useful information for understanding a company's business and earnings and for predicting its future cash flows. There are several things you can do when you evaluate the cash flow statement. Number one, you can evaluate where the major sources and uses of cash flow are between the major categories of operating, investing, and financing activities. As you might imagine, for a startup, operating cash flow might be low or negative. Investing cash flow might be high, in the sense that there is lots of money being spent on investing, so that would be a big negative number. And financing activity would have to be positive because money is being raised. But eventually, as the company matures, then operating cash flow should be going up, investing cash flow might be stabilizing, and in terms of financing, we would be looking at money flowing back to the shareholders or the investors. We also need to look at whether the operating cash flows will cover the capital expenditures of the company. We can also evaluate the primary determinants of operating cash flow. So this is now drilling into the CFO segment of the cash flow statement. We can compare operating cash flow with income. What we would like to see over a period of time is operating cash flow and net income moving together. If we have a situation where net income is going up but CFO is either flat or down, that means that the company is probably recognizing revenue too aggressively, or maybe not considering expenses that it should be considering. We should also look at the consistency of operating cash flows. If cash flows are up and down a lot, that would suggest relatively high risk in this business. We can evaluate the primary determinants of investing cash flow. Now, if a company is getting a lot of money because it is selling its equipment, then that will raise questions about the company's future ability to generate cash. We should also evaluate the primary determinants of financing cash flow. So this will give us an indication about the company's capital structure and plans related to how future operations will be funded. Common sized analysis. If you recall, with the income statement, our common sized analysis involved taking every number on the income statement and dividing by revenue. With the balance sheet, our common sized analysis involved taking every number on the balance sheet and dividing by total assets. With the cash flow statement, we can use two approaches. One approach is to express every line item of cash inflow as a percentage of total inflows, and every line item of outflow as a percentage of total outflows. So if we create a simple example over here, let's say a given company has receipt from customers equal to 900, the sale of equipment for a given period is 50, and the issue of shares is 50. So let's say the total inflows are 1000. Using the first method, We then take each of these major inflows, and in this simplistic example, let's say these are all the inflows. Then we take receipt from customers 900 as a percentage of total. So we are saying that 90% of our inflow is coming from here. We have about 5% coming from the sale of equipment and 5% coming from the issue of shares. You can see that a more detailed analysis will tell us where a company is getting its money from. If you notice that a company is getting most of its money from this source, sale of equipment, then that would clearly be a concern. For a strong company, most of the inflow should be coming from customers, from its core operation. Another way of dealing with the common sized statement is to take every number and express it as a percentage of revenue. The revenue obviously would come from the income statement. Here again we take the actual numbers, say 950 and 50, and let's say that the total revenue is equal to 1100. Then we simply take the percentage of 1100. So 900 divided by 1100, 50 divided by 1100, and so on. So these are just two different techniques, and in the industry both are used. Moving now to free cash flow to firm, or FCFF, and free cash flow to equity. These are extremely important concepts, especially for the CFA level 2 exam. At level 1, you need to understand the basics and ideally memorize the formulas that I'm going to share with you, but this becomes much more important at later levels. So let's understand the concept. A firm generates cash. So let's say there are revenues and then a company pays off all its expenses. Who does the cash belong to? The lenders and the shareholders, in a sense, these are the investors. They have a claim against the cash that the firm generates. Free cash flow to firm is essentially the cash which is available to all the suppliers of capital. The lenders, these might be bondholders for example, and the shareholders. You need to learn the formula for this free cash flow to firm. The formula is net income. This comes from the income statement, plus non-cash charges. Why are we adding non-cash charges like depreciation? Because net income was arrived at after subtracting depreciation. So we are simply adding it back because we are looking at a cash flow. Then we also add back after-tax interest. Why? The reason is we are looking at cash available to all suppliers of capital. Net income was arrived at after subtracting interest, but we want to know how much money is also available to the lenders. So we add back after-tax interest. But then we have to subtract the investments in fixed capital and the investments in working capital. The reason being that when we calculate free cash flow to firm, we want to look at the free cash flow assuming that the company will sustain. And to sustain, obviously, the company needs to make investments in fixed capital and working capital. So during a given period, there will be certain fixed capital investments, they have to be subtracted, and there will be working capital investments, they need to be subtracted either. So this overall expression tells us the free cash flow to firm. Firm here being all the suppliers of capital. Another way of expressing this formula is given right here. Free cash flow to firm can also be written as CFO, cash flow from operations, plus after-tax interest minus the investment in fixed capital. Now, here we are assuming that the interest amount has been subtracted to come up with CFO. That's why the after-tax interest is added back. And then we subtract the investment in fixed capital. We do not subtract the investment in working capital because that is already addressed in CFO. Free cash flow to equity is given by these expressions. This is the money that is available to shareholders. So a firm generates cash. First, the lenders get their money back, the interest as well as the debt repayments. And then what is left is called the free cash flow to equity, or free cash flow available to equity holders. That is expressed as follows: CFO, which is cash flow from operations, minus the fixed capital investment, and then any net borrowing. If a company is borrowing money, then this would be positive. If the company is paying back more money than it is borrowing, then this would be negative. And that negative is expressed over here. So minus net debt repayments. Coming now to cash flow ratios, and these are not as bad as they might look. You can simply read these a few times and I will help you understand what we are talking about. Cash flow to revenue ratio. Here we are looking at the cash flow from operations divided by revenue. And here we don't necessarily have a good number or a bad number. We really need to look at numbers relative to the industry. But all else equal, a high cash flow from operations relative to revenue is a good sign. Cash return on assets. This is the cash flow from operations divided by total assets. Here again, all else equal, the higher the better. Cash return on equity is the cash flow from operations divided by average shareholders' equity over a given period. Cash to income, this is CFO divided by operating income. Here the key is for this ratio to remain relatively stable. If this ratio is going down, that would imply that a company might be showing higher operating income than it should be. Cash flow per share is the cash flow from operations minus the preferred dividends divided by the number of shares outstanding. This is roughly analogous to EPS, where instead of using earnings, we are using cash flow from operations. More ratios. Debt coverage. This is the cash flow from operations, so how much cash flow a company is generating divided by total debt. You want a high ratio because for a certain level of debt, a high cash flow from operation is a good thing. If you have low total debt and high cash flow from operation, that means that the financial risk and financial leverage is low. Interest coverage ratio, this is equal to the cash flow from operations plus interest paid plus taxes paid divided by interest paid. Now, why do we have all these pluses over here? To come up with CFO, if you recall, we typically subtract interest and we also subtract taxes. So we are looking at how much total money is available to pay interest. Therefore, we add back the interest amount and tax paid amount and divide by interest paid. Here again, a high ratio is good. So a high ratio tells us that the interest payments can be made very easily, because if interest amounts are small and cash flow is high, then the ratio is high. If you are lending money to an entity, you would be looking for high coverage ratios. The reinvestment ratio is cash flow from operations divided by cash paid for long-term assets. Debt repayment, CFO divided by cash paid for long-term debt repayment. Dividend payment, CFO divided by dividend payments. And what it measures, ability to pay debts with outstanding cash flows, or ability to pay dividends with operating cash flows. Investing and financing, this is CFO divided by cash flows for investing and financing activities. This tells us about the ability to acquire assets, pay debts, and make distributions to owners. I don't think it is hugely important for you to memorize all these ratios, but just by looking at them, you should get a sense for what they are measuring. So we now come to the end of this very important reading. A quick summary. You need to understand operating activities, investing activities, and financing activities. Operating has to do with the core day-to-day operation of a company. Investing has to do with buying or selling of long-term assets or investments. And financing activity has to do with the flow of cash between a company and providers of capital. You need to understand how different cash flow items are treated under IFRS and US GAAP, and the critical ones to understand are interest received, interest paid, dividends received, and dividends paid. So the table which I showed you must be memorized. You need to understand the direct format and the indirect format for the cash flow statement. Remember that this distinction only applies in the CFO segment. CFF and CFI only have a direct format. You need to recognize that the cash flow statement can be derived from the income statement and the balance sheet. Very simplistically, we take items out of the income statement, such as revenue, and then we look at the change in accounts receivable to come up with the cash flow or the cash received from customers. We need to understand the steps in preparing both the direct and indirect cash flow statements. I think this particular item is highly testable. We talked about cash flow analysis. You need to be on top of that, and the concept behind free cash flow to firm and free cash flow to equity. As always, go over the summary, review the learning objectives, try to do all the examples in the curriculum. If you find them too long, don't spend too much time on them. Just try to get a flavor for what they are about, but definitely do the practice problems and also try to do practice problems from other sources. That is it.